So thanks a lot to all of you for joining this AFME webinar on a very timely topic on sectorization. My name is Remy Kiresh. I'm a director at AFME responsible for sectorization. I'm glad to see so many of you joining today. Just a few weeks before the Commission, almost a month before the Commission is expected to publish its proposal mid-June on 17 on sectorization, which will be the first deliverable of the SIU strategy. As a few words of introduction, I think it's good to see from our perspective that the valuable of sectorization has been acknowledged seems to have been acknowledged in the last couple of months, and there is an increasing recognition that the existing regulatory framework does not allow to deploy sectorization to its full potential to support the growth and competitiveness of the EU economy. And so today, to discuss sectorization, I'm glad to be joined by two distinguished experts on this matter. So we have with us Thomas Papadogiannis Varoukakis. Sorry, Thomas, for my pronunciation. Thomas is an assistant professor in commercial at the University of Nottingham in the United Kingdom. He has published extensive research on sectorization and cover bonds in academic and practitioner journals in the UK and Greece. Today also, we have the pleasure to welcome Sean Badley, AFME Sectorization Managing Director. Sean has nearly 25 years of experience in the sectorization industry, having most recently worked for Santander as Managing Director, Head of European ABS in Global Debt Financing at Santander Corporate Investment Banking. So we have two very well-known experts on sectorization, which I hope will give you a sense of the state of play and a bit of an idea of how about the way forward and of some of the ideas. So how we are going to structure this webinar? First, we will I will after my introduction, Sean will give you a snapshot of with some context and figures of what the sectorization market looks like. And then we'll have two presentations, one by Thomas, which will go through the conduct reform post the great financial crisis and how they have been implemented, in particular in the EU through the sectorization regulation. And then Sean will go a bit more in the details in terms of the trends and give a bit of an overview of the performance of the product, and including some idea that AFME has in terms of targeted reform that we believe are needed to revive the sectorization market to help the objective of the SIU. So before we kick off, I can't stress enough that this webinar is for the audience benefits primarily. So I really encourage all the participants to ask any questions that you may have. So there is a Q&A functions in Zoom. So please, if you have any questions, please put them directly in the Q&A functions. Those are anonymous questions, so if I may, don't be shy. With the two panelists over here and myself are really there to be able to answer to any questions, even the most challenging questions. I think that's really the purpose of the webinar, to have a dialogue on the section on sectorization and its regulatory framework. So that being said, to kick off, I just want to leave the floor to Sean Badley for some contextual point. Sean, the floor is yours.
Thanks, Remy. That's helpful. So I thought before I hand over to Thomas, it may be useful just to consider the full scope of products that are issued under securitization regulation, and this pie seeks to encapsulate all those products. So issuance last year, 2024, in Europe. It's an estimation because some of this market is private, and so we have a sense for volumes, but they are somewhat caveated, these numbers, and the numbers will likely be higher because this is sort of bank originated focus. So for example, asset managers using securitization privately to finance their own portfolios would not be incorporated within these numbers. And so what you see briefly is in green, securitization being used as a financing tool. In yellow, as a risk transfer tool from banks' balance sheets synthetically. In grey, used by banks to deconsolidate non-performing loans, so to sell portfolios of NPLs into the market. And then that very thin orange tranche is also significant risk transfer, but on a funded basis, so using traditional securitization. So briefly looking at the green segments, you'll see a light green, mid, and dark green. The light green you'll see marked as private, and so that's primarily used by banks to finance their commercial and investment banking clients, so non-financial corporates and non-bank financials, where they are providing non-recourse financing to their clients, trade receivables, autos, leases, mortgages, etc., being the outer band. So that's an important component part for banks to finance their client base. And clearly the reliance upon the banking sector to finance growth in the EU economy, that is an alternate and important way for banks to provide lines to that client base. And that's been pretty steady over the past 10 years in terms of volumes. The middle area is public ABS, so where issuers, so lenders are using securitization to finance their lending through the public ABS markets, and that is the market that has suffered the most. And it is the focus of many reforms to reinvigorate. Dark green is retained securitization, where banks are using securitization to repo with their central banks or privately with counterparts as well. Orange, as I've mentioned, so significant risk transfer synthetically, and you can see the asset classes that are typically used, and that is obviously a banking product, and it is a private market as well. I think I'll probably stop there. I'll come back to this slide briefly when I present my side, but Remy, I think I'll hand over to Thomas now to carry on.
Oh, thanks very much, Sean. I just wanted to clarify that now we will have 10 minutes presentation each by each participant. So Thomas first, and then I really encourage, as I said, participant to we'll have a Q&A session with the panelists. So please put your question in the chat again. And one question was already asked about whether or not we are going to share the slides deck of the panelists. Yes, we will circulate an email with the presentation after this webinar. That being said, I think we now move to Thomas' presentation on the conduct rule post GFC. Thanks again, Thomas, for joining us today.
Thank you very much, Remy, and everyone else from AFME for having me and for organizing this webinar. Welcome, everyone. As Remy already very kindly explained, the focus of my presentation will be on the conduct regulation of securitization as distinct from prudential regulation of securitization. In other words, what I'm going to be focusing on is the kind of regulatory rules that dictate how market participants in the securitization market are expected to act and behave. Specifically, what I'm going to discuss are due diligence obligations imposed on investors in the securitization market, as well as disclosure obligations and risk retention obligations imposed on sell-side entities in the securitization market. I'm also going to refer briefly to the treatment of resecuritization structures, as well as the application of credit granting standards for loans that are used as collateral for securitizations. Now, the first thing I want to highlight in my presentation is the direct link that exists between, on the one hand, the development of such conduct regulation I just mentioned and the global financial crisis that took place in 2007 to 2009, and specifically the role that securitization played or was perceived to have played during the crisis. What I want to illustrate in particular is how this conduct regulation of securitization was developed after the crisis as a means of responding to the perceived failings of securitization during the 2007-2009 crisis. Moreover, although the focus of my presentation will be on the EU regulatory framework, I will also refer briefly to the recommendations on conduct regulation made on the aftermath of the crisis by the BCBS and IOSCO, the Basel Committee on Banking Supervision, that is, and the International Organization of Securities Commission, and the ways in which the EU and other jurisdictions incorporated those recommendations in their own regulatory frameworks. And finally, what I want to do is briefly touch upon the current iteration of conduct regulation in the EU, the SCCR, that is, Regulation 2017-2402, Articles 5 to 9, and do that by drawing a brief comparison with the US and the UK version of the rules. The point of this exercise is to gauge how the EU conduct regulation of securitization compares to its counterparts in terms of its comprehensiveness and in terms of its efficiency. All right, so the first thing to note here is that this kind of conduct regulation, so due diligence obligations and disclosure obligations and risk retention, etc., did not really exist before the global financial crisis, either at the EU level or at the international level. This does not mean, of course, that securitization was not regulated before the crisis. It was, but this regulation was rather prudential. It was mostly about capital requirements for banks that invested in securitization positions. Following the global financial crisis, of course, as you very well know, securitization found itself at the center of criticism against quote-unquote bad financial innovation, and a conventional narrative, if you will, was weaved surrounding the perceived weaknesses of securitization. In response, a set of rules and a set of principles were developed which aimed to fix those perceived weaknesses as identified by the conventional narrative. What do I mean by that? Well, those weaknesses revolved around the quote-unquote perverse incentives that securitization was thought to have fueled during the crisis. Securitization was thought to have incentivized credit institutions and originators more generally to significantly lower their credit granting standards and basically give mortgage loans to people who could not really afford them, subprime loans. And they were incentivized to do that because thanks to securitization, according to the conventional narrative, of course, they could get rid of those subprime loans by repackaging them in opaque structures and then transfer them along with the relevant risk to the wider market. And market participants and investors would invest in those structures, according to this narrative, because, first of all, sell-side entities did not really have to disclose much information about those transactions. And even if they did, investors could not really understand what they were buying because of how opaque it was, or they didn't bother to understand it because of the very good credit ratings that credit rating agencies assigned to those structures, and that's all that mattered at the time. Now, obviously, this is a simplistic depiction of the things and things that happened during the global financial crisis. I'm not suggesting that none of those accusations has any basis, but what I can say with some confidence, and I think it's accepted more generally today, is that reality was much more nuanced than what this conventional narrative suggested at the time. That said, because of how dominant it was, this conventional narrative really played a role and affected the recommendations made in the aftermath of the crisis by BCBS and by IOSCO regarding this conduct regulation of securitization. What do I mean when I say it affected the recommendations? What are those recommendations? Well, how do you make sure, if you think that there are those kind of perverse incentives, how do you make sure that you align the incentives of sell-side entities and buy-side entities in the securitization market? Well, according to BCBS and IOSCO, you do that, first of all, by requiring sell-side entities to keep quote-unquote skin in the game, a net economic interest, in other words, in the underlying assets that they are securitizing. And how do you make sure that investors can understand what they're buying? Well, you do that by requiring sell-side entities to disclose a certain amount of information about the transaction and the underlying assets and the underlying risks to investors. And you also require investors to conduct due diligence about the structures in which they're about to invest. So all those things were indeed recommended by the BCBS and IOSCO in the form of high-level principles in the aftermath of the crisis. And both the EU, which of course included the UK at the time, and the US incorporated those principles through rules in their own regulatory frameworks. What is interesting here to note is that the EU went quite beyond what the BCBS and IOSCO was recommending at the time in a form of gold plating and imposed additional obligations to sell-side entities. For instance, the obligation to apply the same criteria for granting loans that would be then securitized as they would if those loans were not going to be securitized. So same credit granting criteria regardless of the purpose behind the origination of a loan. The idea behind this measure was to ensure that in the future, credit institutions would not have the incentive or the ability to do what they did or were perceived to have done during the crisis, that is, lower the credit granting standards and then originate subprime loans that they could then transfer to the wider market. That was the idea. So we can see how the EU went beyond what was already being suggested and increased the safety of the framework that it was creating. Now, staying with the EU, it's worth mentioning that those conduct rules I mentioned earlier were originally sectoral, in the sense that they were included in different pieces of regulation that applied with slight variations depending on the type of investing entity we were dealing with, depending on whether we were dealing with a bank or an insurer or an alternative investment fund manager. Today, however, all those conduct rules are included in the SCCR, Regulation 2017-2402, Articles 5 to 9, so they apply uniformly to practically everyone who is involved in the EU securitization market. Another thing to note, which is important in this context, is that as we moved away from sectoral requirements to the SCCR, the conduct regulation of securitization in the EU became increasingly complex and increasingly comprehensive. To give you just a few examples, the list of issues on which investors have to conduct due diligence under Article 5 of the SCCR is way more detailed than what we had in the past. And the same holds true for disclosure obligations, because the principle-based obligations that sell-side entities had to adhere to under the previous regime, the Capital Requirements Directive, the CRD, has now become much more extensive and much more detailed as a rule in Article 7 of the SCCR. This rule requires sell-side entities to make templated disclosures to not just investors, as was the case under the CRD, but also to potential investors and also to competent authorities. Another thing that is worth noting in this context is that for the first time under this SCCR, under Article 8 to be more precise, there is an effective ban on resecuritizations, that is, securitizations that include other securitization positions as an underlying asset. This measure was introduced on the basis that resecuritizations, at least in the eyes of the EU regulator, could potentially compromise the level of transparency that the SCCR sought to establish. At the same time, in other jurisdictions, the direction of travel has been quite different, because conduct regulation of securitization in places like the US and the UK is arguably becoming gradually less comprehensive and prescriptive. Again, to give a few examples, in the US, risk retention obligations no longer apply to certain types of CLO securitizations, whereas credit granting criteria for securitized loans were never introduced in the US, nor did any kind of ban on resecuritization. In the UK, the PRA, the Prudential Regulation Authority, is no longer requiring investors to conduct due diligence by obtaining information in prescribed templates, the way it used to be and the way it's still done in the EU, and instead it's focusing on whether enough information has been given to those investors so they can independently assess the risk of holding the relevant securitization position. So in that sense, due diligence obligations in the UK are more principle-based than they used to be. So to conclude, even though conduct regulation exists in all those jurisdictions that I just mentioned, in the EU and the UK and the US, the EU rules are arguably more comprehensive, and that makes them a bit more costly and a bit harder to follow compared to those other jurisdictions. In fact, it's accepted even by EU authorities nowadays that conduct regulation of securitization is currently so comprehensive that it ends up being inefficient in a sense. And it does not really help the EU securitization market to expand as the EU regulator would want it to. Now, the way in which we can make conduct regulation more proportionate and more efficient is still a matter of debate between the market and between the EU authorities. But hopefully, following the Commission's report next month, the direction of travel will become a bit clearer. This brings us to the end of my presentation. Thank you very much for your time and your attention, and I look forward to your comments and questions. Remy, back to you.
Thanks. Thanks a lot, Thomas. I think it was a very good overview of I think the strong safeguard put in place post-financial crisis, which I think has helped in a way to to bring back confidence in this market to a certain extent. But indeed, debate is ongoing on whether on the potential targeted adjustment towards a bit more simplified framework. Thanks a lot very much to Matt. And as Thomas said, if you have any question on this presentation, I would like to challenge him on certain of his points. At the end of the Sean presentation, do not hesitate to put a question in the Q&A function chat. Sean, I would like now to give you the floor to give a bit of an overview of the trends you already highlighted to the subdue public ABS market. And I think it's important to look at this market specifically and maybe also have a bit of perspective on the default trades, because section in the past has been accused of being a risky product. And then maybe you can say a few words on what we believe might be necessary to revive the securitization market. Sean, floor is yours.
Sure, Remy, thanks. And hopefully people can see the slide that I had on the screen at the beginning of the presentation. Just a couple of points to this slide. Well, as Remy mentioned at the beginning, the Savings and Investment Union strategy has acknowledged the potential for securitization to boost investment and achieve part of the SIU's objectives. I think we all recognize that it's not the only solution to create a more efficient and liquid European capital markets, but it's certainly an important element of our financing toolbox. And we believe, and I think, and others do as well, that it's one that Europe can activate in the short term. So, from AFME's perspective, what is key here is to come up with solutions that are relevant, proportionate, and risk sensitive, achievable in the short term, and form part of a package. It's not possible just to sort of pick and choose certain elements of packages that are proposed. It really needs to work as a package, because all these different elements are very much interconnected. So if we move on to issuance trends for public ABS and SRT, forming the two principal markets that I outlined in that pie, you can see that the very different trajectories across those two products. So publicly placed ABS issuance has pretty much flatlined since post-crisis. And pre-crisis, it built up to the levels you see there over 10 years. And so, another way of perhaps measuring this is, the contribution of public ABS to GDP growth. In the EU, public ABS forms part of about 50 basis points, so half of 1% of GDP, versus 5 to 10 times that in other jurisdictions or blocks that use securitization. SRT, however, has continued to grow, significant risk transfer. So banks using securitization to transfer risk off banks' balance sheets since the early 2000s, and it's grown fourfold since 2018. And the reason for these very different trajectories is down to supply and demand side measures, which have challenged the growth in both segments, frankly, certainly in the public ABS market, which is very clear to see, but also in the SRT market, given that that growth is evidenced through growth amongst a subset of banks that are internal ratings based. So the larger banks, 40% of capital is locked up within standardized formulae banks or portfolios held by banks. And a lot of those portfolios are much harder to transfer risk from, given the bank prudential frameworks. So that's another area of focus for us. So I think with that, I will move on to the next slide. And this comes down to the key issue of performance. And what you can see here is comparative default rates of securitization versus other asset classes over 40 years. So top left quadrant, you see securitization. And when I talk about securitization here, I'm talking about securitization permissible under the existing regulation, both STS and non-STS of the principal issuance segments. So being ABS, RMBS, and CLOs as well, which form the majority of issuance since the implementation of the EU Securitization Regulation 2019 by rating, by rated tranche. So over 40 years of data, this is S&P data, they have looked at cumulative default rates over every 5-year period. So from, let's say, 1990 to 1995, 1991 to 1996, etc., and then looked at averages across that 40-year study period. And you can see that securitization, both STS and non-STS, has performed equivalently or in some cases better than other products across the rating spectrum. So, for example, we can see single A rated securitization around, this is a logarithmic scale on the y-axis, but are around 30 basis points, 31%, versus sovereigns, for example, which is over 1% of default rates over that 5-year period, averaged over 40 years. So, it's important to keep that in mind, because I think we all, it's easy to reflect on the performance of those products issued prior to the global financial crisis, so between 2002 and 2006, which are prohibited under the existing regulation, as Thomas eloquently highlighted, and distorts default numbers. The reality is what can be issued today under the existing regulation has performed phenomenally well over 40 years. And I think with that in mind, we can turn to some of the issues around the bank prudential frameworks arising from that default, that perception of default post-crisis. And I think there was a recognition that securitization was a complex product, and there were risks, namely agency and model risk, which did not exist in other products. And as a result of that, those risks needed to feed into the concept of capital non-neutrality, which you may have heard about, the idea that if you securitize a portfolio, the capital held on those securitized tranches should be more than the pre-securitized portfolio. And that fed into formally created, as a standardized approach and the internal ratings-based approach as well, governed by a parameter called P, which in effect elevates capital post-securitization. For STS, currently at 0.5, and for non-STS at 1, meaning that there is a capital uplift across the securitized tranches of 50% for STS tranches and 100% for non-STS tranches. And in those formulae, there's an inherent problem which does need to be resolved at some stage, which is so-called cliff risk, which you can see in the slide. So briefly summarizing the slide, you can see a red line which increases to the left up to 1,250% risk weight, and a red vertical tranche, which is so referenced in the Joint Usage Report 2022, a micro tranche detaching and attaching around or above KRB or KSA. And evidently, as that exposure of that micro tranche deteriorates in terms of credit quality, the capital required against that exposure as that vertical tranche moves to the left increases substantially, and that is the so-called cliff risk of somebody holding that micro tranche of mezzanine risk. Banks' core business is holding senior risk. So in the example I was giving earlier, that light green segment is banks financing corporate clients through senior tranches held against the client. And indeed, in significant risk transfer transactions, the residual senior piece is held by the bank, whilst unexpected losses are sold, and sometimes expected losses are sold to third parties. So we're talking about a senior risk that is the bank's core business. And much in the same way as you see the red line accreting to the left, if you model that senior risk as the reference portfolio deteriorates, making assumptions about where the senior risk attaches, but always detaching at 100%, you can see the green line slowly increasing to the left, reflecting increased capital held by the bank against that exposure as the reference portfolio deteriorates, up to and capped at the risk weight of the underlying portfolio, in this case around 100%. So, to the extent banks are conducting core business and holding senior risk, that cliff risk associated with the inadequacies of the existing formulae for Sec SA and Sec IRBA is substantially limited. The setting of P was broadly to incorporate that agency and model risk, but also in recognition of the risk of undercapitalizing the risk just above KIRB or KSA. And so that has been one of the reasons why there has been a reluctance to reduce P in that context. As you may know, under CRR3, the CRR3 package, P was indeed halved to 0.5 and 0.25 for non-STS and STS in the context of output floors, recognizing the unintended consequences of output floors in securitization with a sort of accelerator effect on capital. What AFME is suggesting is, until such time that a wholesale review of these formulae is implemented, and great if it can be implemented in the short term, but we are comfortable that, and you will see in AFME's original proposals, extending the CRR3 package to halve P to 0.25 and 0.5 for STS and non-STS for Sec SA, and then reducing the floor for Sec IRBA is financially systemically prudent from a sort of micro pru and a macro pru perspective, having conducted some impact analysis which was submitted to the Commission as part of the AFME's response to the Commission, alongside a reduction in risk weight floors from 10 and 15% to 7 and 12%. So, these are measures that we believe can be implemented in the short term in a way that will support SIU and are systemically prudent. There are other solutions that are being discussed which are also good, and if they can be considered or implemented in the very short term, which is what is needed here, then great. If it's part of a phase 2 solution, good as well. But the overarching issue here is to resolve supply side constraints in terms of growing SRT in the short term, to ensure that banks can contribute to continuing to finance growth whilst developing the capital markets liquidity as well for the product. So that is the first element, and I'm focusing here. The package proposed by AFME is quite broad ranging. I think some of the elements, the regulatory elements that have been discussed in terms of, and Thomas touched upon in relation to Article 7, so disclosure frameworks and due diligence frameworks, are perhaps less contentious. I think there's some concerns that need to be overcome, but I think as part of this overall package that we've been referring to, the prudential measures are very important as well, hence my focus on these during this presentation. So the second point I'd like to touch upon is in relation to LCR. And, within the LCR, as you may know, securitization is treated as level 2B with haircuts between 25 and 35%, depending upon the underlying asset class. There are requirements around STS, to Thomas's point around gold plating. STS is not a requirement under Basel, and indeed no other bloc around the world has incorporated STS as part of their own LCR requirements. And there are additional eligibility criteria that, again, are not recommended at Basel's level. But the key point for us here is that a lot of the treatment for securitization within LCR is a function of the lack of liquidity that arose post GFC, which was somewhat endogenous because clearly, the lack of transparency in the underlying product was a cause for that lockup of liquidity in the product. So it was endogenous to the product, much in the same way that during the Euro sovereign debt crisis, there was very little liquidity for some of the peripheral government bonds at the time, because again, it was endogenous to the product. And the reality is that securitization has a very important role to play for banks in accessing diversified pools of liquidity. Why so? Well, we can see it most recently, and there's frequently cited examples in relation to, in the UK, the LDI crisis, where asset managers following LDI strategies had to liquidate some of their portfolios to meet margin calls. And they often invariably turned to, in a rising rates environment, floating rate product. There's very little floating rate product that they were holding, investment grade floating rate, but securitization and structured credit formed a large part of that. And that assisted them in generating liquidity without taking significant market value loss at a time of liquidity stress for those managers. Much in the same way we've seen in the US, issues arising from interest rate risk for the likes of Silicon Valley Bank and Signature Bank, arising from large exposure to fixed rate product. The reality is that in the EU bond markets, 85% of the markets are fixed rate. If you look at covered bonds, you have about 80% of that product is fixed rate. Securitization is one of the few asset classes where over 75% of the bonds are in fact floating rate. If you consider that in those public ABS markets that I was referring to, no more than 3% of the EU bond market is made up of ABS, so investment grade, typically AAA, AA ABS, whilst securitization makes up over 20% of all floating rate bonds outstanding. So it's very much punching above its weight, and it's not helpful, we believe, for LCR frameworks to penalize securitization through eligibility treatment and haircuts, such that banks do not have access to the product that they could have. I think with an HQLA of around 5 trillion euros, there is no more than 30 basis points of AUM held within securitization. And clearly, if that were, forming a functional part of its diversified liquidity at, let's say, 5%, that would result in around 250 billion euros of ABS outstanding held by banks to form part of its diversified liquidity. That also supports SIU in terms of delivering the 800 billion a year needs. to financing the transition. But the primary concern here is around accessing diversified liquidity by banks, which we think is key. And that drives AFME's proposals around LCR, so improved haircut treatment, expanding eligibility for securitisations, which indeed is in line with Basel proposals to include AA category, removing weighted average life limits. You'll see in the link when we circulate the presentation an AFME survey where we went out to 25 bank treasuries in the EU to understand exactly what the concerns were that they had around LCR, securitisation forming part of LCR, or their inability to invest greater. And in brief, it is haircut levels, it's the eligibility criteria, and its lack of supply. So please do have a look at that when you have a moment. Sticking with prudential risk, the last point I want to touch upon is in relation to Solvency II, which again has been debated. We believe it is a very important element. Again, a 5 trillion euro source of investment. Again, around 30 basis points of investment held in securitisation in Europe versus I think around 25% in other parts of the world. So significantly underallocated to securitisation, and that was, as AFME surveys show, arising from implementation of Solvency II. So we're talking about standard formula insurers here. And the big issue for insurers is twofold. One is the existing Solvency II framework creates substantial prudential risks for insurers, and this slide shows that well, and we can talk about that. And secondly, the effect of elevating capital in a non-risk sensitive way disproportionately significantly impacts returns of capital, which we will see in the subsequent slide. But briefly, looking at this slide, what you can see in the chart is, so we have, for example, a 5-year RMBS rated AAA, which is STS. Capital allocated to that position is 5%. If it were to lose its STS label, which would not be something which would necessarily be in the wit of, well, certainly not in the wit of the investor, but potentially not in the wit of the originator as well. And it's not a BA business as usual issue, but it may happen. That would result in the insurer having to hold overnight a 12 times capital against that position. And you can see the effect also for AA SME ABS and also for auto ABS as well. So that significant increase moving from STS to non-STS, which is not risk sensitive. Indeed, you can see as a reference point type 1 equities, where 39% of capital is held, which is almost half the amount that would be required from an insurer holding AAA RMBS and losing its STS label. So this disincentivizes insurers very, very clearly. Faced with that level of regulatory risk as a result of a non-risk sensitive framework, challenges investments. We'll see some details on the right around case studies, which you'll see as we follow up post webinar. In terms of returns on capital, you can see the same effect in my second point here, where if you look at Euro CLOs, which is a non-STS product, the capital held on that AAA CLO, which drives the return on capital. I think this is something that is not clearly understood, but the margins on these products are a function of the market, and they will not gap out as a result of capital from capital requirements from an investor who is somewhat tangential to the market. So the returns on capital arising from the high capital requirements on the product make it absolutely uninteresting for an insurer. Conversely, you can see in the US the high returns on capital for the same product for US insurers, which, as you would expect, reduces as you go down the rating spectrum to the far right, single B. So in effect, if you're holding an investment grade product, if you look at that fourth bar to the right, where you have, that's 1 year capital requirement for a triple B CLO. If you were to look at 5-year capital requirements, that would be around 1-to-1 capital held on a triple B product. And even at single A level, close to that as well. So, significantly disincentivizing insurers from participating in this market. And actually, having perverse incentives of driving them down the capital structure, because clearly, they're capped out at 1-to-1 capital as they move down the capital structure. So they can make returns perhaps counterintuitively work way down at sort of very low investment grade. And that just highlights the lack of risk sensitivity in the framework, which does need to be resolved. And that's reflected in this summarized statement. And you can see we've done a lot of work, quantitative research with Risk Control Limited, looking at capital calibrations on this product, which deduce from that where appropriate capital treatment may reside. As I said, I'm focusing on the capital side, the prudential elements for banks and insurers. Importantly, there are some regulatory reforms that are required. I think, in terms of due diligence requirements, as we've seen in the UK, principle-based approach are being adopted. I have some more comfort that we're moving towards the right direction in the EU in relation to proportionate due diligence requirements. I would caution that on the one hand, moving to a proportionate, less prescriptive Article 5 framework is helpful, but to implement sanctions upon sanctions that are disproportionate for non-compliance will actually have the counter effect of just keeping investors away from the product. It's what is needed from these reforms is an Article 5 investor DD framework that is encouraging investors to come to invest in senior ABS, which supports SIU, where into products, AAA products, and I've shown the historical default rates on those products, which have been phenomenally strong. But to have investor DD reforms that reflect the risks there, and not to introduce counter effects arising from disproportionate sanctions. I think disclosure requirements. I think we're again moving in the right direction as well in terms of having proportionate disclosure for private securitisations, where the reality is investors have as much information as they want, and seek that information on transactions which are often bespoke, and it's very difficult to create detailed templates around such products. So I show you a number of links through to some research that we've published in this relation. Remy, I'll hand back to you. I'm afraid I've taken a little bit more time than I anticipated.
Thanks a lot, Sean. It has been very, very helpful, and I will encourage all of the participants to direct you any question they may have on the different charts that you showed them, because it might sound pretty technical. So we are happy to provide any further explanations on those as well. We got some question in the chat, so now we have the time is for questions. So I think the first one, maybe I would get back to Thomas. There was one on the EU securitisation regulation. think there was a question which tried to maybe clarify your views on how the securitization regulation has been effective in achieving its original objective, in the sense that the questions understand that your assessment of the SEC reg is that it has been inefficient. I'm not sure you went so far as inefficient, but maybe you would like to clarify that point.
Right. Thank you very much, Remy, and thank you to whoever asked that question, because it's a relevant question. What I did mention in my presentation was indeed that, at least according to the regulatory authorities in the EU, the current conduct regulation of securitization is so comprehensive that it ends up being inefficient in terms of not helping the EU securitization market to grow the way the EU regulator would want it to grow. I think, and I agree with this statement. So when I say inefficient, it's important to understand what I mean when I say inefficiency. So one of the original objectives of the SCCR, the framework that was introduced after 2019, was to help the EU securitization market recover from the standstill it had been ever since the global financial crisis. That was one of the stated objectives of the new framework that was introduced at the time. Doing that, of course, in a way that does not compromise financial stability, but still, the regulator accepted that we needed a bigger market. And more recent reports, the Draghi report being a good example, confirm that a bigger and more effective securitization market is indeed needed in order for the CMU or the CIU to achieve its objectives. So to the extent that regulation plays a role in the size of the securitization market, then we can say that what we have right now has not helped. The conduct regulation that we have right now has not helped. And I have conducted research that shows that there is a link between the way that securitization structures are treated and the effect this has on market participants, both sell-side entities and buy-side entities. So there is, to the extent that there is comparability between different products, securitization products and other products, and to the extent that securitization structures are treated unfavorably, there is proof that this has not helped the market to grow, because it has incentivized market participants to go elsewhere. So in that sense, I would agree that there is some sort of inefficiency.
Thanks a lot, Thomas. Very interesting to have your views on that, and maybe we can add some of your research when we send the slide. I think some participants will be interested in those. Thanks a lot. What maybe questions to show now? So we have some question on the SRT transaction, and one question in relation to the insurer's role relation to SRT, in the sense that will it help? I think the question is like, will it help the growth of the SRT transaction in the SRT market if insurers will be able to provide trade protections to those transactions? I think it's already the case, but maybe the questions relate to some more specific angles of debate, in particular unfunded STS, SRT synthetic transaction. Maybe Sean, you can give a big picture of the role of insurers in the SRT market, and maybe also public ABS market, because as we have seen, the SRT market is working pretty well, and maybe to address, try to address this STS unfunded synthetic, which I think maybe I'll be on this question.
Yeah. So thanks, Remy. Yeah, as you say, I mean, in the EU market, insurers have an important role to play already in providing unfunded protection to originators looking to transfer risk. And it's important to state that the role of insurers here is the type of insurers engaging in this product is very different to the role of insurers participating in terms of monoline insurers pre-crisis. These are insurers that have very diversified business models and are not taking concentration risk to this product. And so they do play an important role already. I think there's a debate ongoing around whether insurers can engage in SRT on an unfunded basis for STS transactions, the importance of that is that because at the moment, as soon as an insurer participates,
Sean,
yeah,
is it me or do you all have an issue with there is I think there is some sound issue with your mic, Sean.
Okay. Is that better?
Yeah, not really. Maybe I will go to Thomas with another questions and maybe you can see if you can fix. Fine. Sorry about that. So for you, Thomas, I think there are a couple of questions which one I think maybe some clarification point is is the EU regulation apply to all securitisation including SRT? I think you can easily clarify that point for the agents.
Yeah, SRT securitization is definitely within the scope of the SCCR and the rules on securitization included in the capital requirements regulation.
And at least I will just add a question on my hand because you're starting a bit developing the comparison with other jurisdictions, and Sean also alluded to the and you too on the ongoing reform in the UK, in particular on the due diligence as far as the SecReg is concerned. I think it would be interesting to hear a bit more in detail what the UK is doing on the due diligence, what exactly the requirement they have been implementing, and what your assessment on those.
Right. So I don't want to say something that is inaccurate because the focus of my academic research is in the EU framework, but I do have some understanding of what the UK is doing. So in my understanding, what the UK is doing, and specifically the Prudential Regulation Authority, the PRA, is moving away from what we had until now, which was basically very much similar to what the EU was doing so far as due diligence was concerned. So a very prescribed, a very comprehensive list of requirements and points of information that investors had to confirm. We're moving away from this towards something that is much more principle-based. So what is required now is for investors to have the necessary information to be able to assess independently the risk of the transaction they are entering into. That's what the PRA and the current rule is focusing on. So instead of saying to investors, you need to make sure that you have checked X, Y, Z, and you have all the information that we ask you to verify, regardless of whether it's useful to you or not, what we want you to do is have all the information you actually need in order to be able to conduct your due diligence. That's what makes it more principle-based than what we had before.
Thanks a lot, Thomas, for your explanation. Can I check with you, Sean, if the mic is a bit better?
Does that sound better to you?
Yeah, sound much better. Can I ask you to start with the insurance point, and then we have another follow-up questions to re-explain a little bit the chart on the cliff risk effect on the green line, but maybe on the insurer's role in the SRT transactions, and then we can move to the bank capital.
Yeah, I'll do. I'm not sure I can because I've moved to a different screen, so I may ask. Well, I'll try and share afterwards. See how I can do it. In terms of what I was saying about insurers, yes, absolutely, they have an important role to play in the EU already. They under the current rules, they cannot participate in STS transactions, or at least if they do, the transaction will no longer be STS as a result of the prohibitions under the STS criteria of unfunded insurers, unfunded protection being provided. So, first of all, systemically, it's important for AFME members would support a diversified investor base and the product being used by a broad range of investors, as it is indeed being used by insurers now. The benefit for banks in unfunded insurance on an STS basis is that that residual senior risk that they'd be holding would attract a lower risk weighting, and so those transactions would be more economically efficient for the originating bank through participation of an unfunded insurer on an SCS basis. So on that basis, it would, to answer the question, it would likely stimulate increased demand in SRT as a result of that change. Yeah, so that's that. Was there a question on, do you say UK prudential?
No, on the chart on the cliff risk effect. I mean, there were some questions whether we can clarify, or what does a green line show? I think the green line showing the difference between the red and the green in terms of cliff risk effect. Let me know if you need me to share the screen. I have the presentations. I can
yeah, yeah, if you can, that'd be great.
Let me do that.
Thanks. Yeah, thank you. So the green line, so the green block reflects bank participation. As you can see in the FSB report, it's something like 95% of exposure by banks is in senior risk in the report that was released a couple of months ago. Through senior financing and through SRT. The green block reflects bank participation by detaching, on the far right at 100% and detaching around and above KIRB or KSA. And that exposure, the risk weight of that exposure is reflected in that green line rather than the red line. And so, if you see deterioration or indeed loss of credit enhancement in that exposure held by the bank, either through SRT or senior financing, the increasing risk weight arising from that follows that green line, such that if there were if all that credit enhancement were lost and went to zero, the risk weight of that exposure would be capped at the risk weight of the underlying portfolio. So in this case, 100%. So that's the point here. Now, I think, legitimately, when we've, as when we've, engaged with the official sector on these discussions, there's been a concern that any changes to P, to resolve these issues in the short term may encourage banks to invest in the mezzanine risk. And we believe there are robust solutions to get around that issue, which we've obviously discussed with the official sector as well. Whether that be limited to senior only, being one. Now, so from a legal perspective, that would restrict the benefit to transactions where the legal definition were met. And it's important to say, when we've looked at the effect of the reduction in P in our own impact analysis, combined with a reduction in the risk weight floor, the stress levels that can be accommodated from that retained senior piece are multiples. So in line with the kind of implied risk rating that those exposures would be assigned either internally or through assignation by a rating agency.
Yeah, no, thanks a lot. I have one question on the SRT market, because one could reflect on that one, and maybe it would be worth having your views on why this market has been performing so well over the last few years, and why banks have been using synthetic SRT in particular to improve the velocity of their balance sheet. I think it would be, because we have very different trend between public ABS and SRT. So yeah, I think it would be interesting to hear your views on that.
Yeah, I mean, I think so the investor base for SRT, so investors that are specialized credit investors or pension funds who are doing in-depth due diligence and analysis on taking exposure to expected losses on these portfolios or unexpected losses, can generate strong risk-adjusted returns, and those returns outweigh the cost of doing business in securitization. What I mean is, the cost of, jumping through numerous hurdles in relation to Article 5, for example. These investors do not have prudential requirements around them. Because as insurers, they're not holding those on the asset side of the balance sheet. Banks aren't holding this risk. So it is risk that is leaving the banking system. So, in short, the returns on capital for these investors is attractive, and they understand that actually, being able to isolate the risk of a consumer portfolio or an SME portfolio or an investment grade corporate portfolio from the idiosyncratic risk of the bank and generating a quasi equity-like return is attractive. Yep. And it's a risk that they can understand.
Thanks, Josh. We have a couple of other questions which are a bit more just on the data that we presented. So I will direct them to you, to Sean, and I think then we can wrap up because we're almost at the end of the webinar. One is on the slide 3. I think the participant refers to STS picks up at the end of Q4 towards year ends. I think slide 3 is not specifically STS, but combine STS and non-STS for public place ABS issuance in Europe. Is there any explanation why for 2024 there was some? It seems to be a bit higher, but I think 2018 also was similar. Is it something cyclical, or there was more interest in the product?
Yeah, it is cyclical. Yeah, as you say, it's not STS, so this is SRT. So this is characteristic of the SRT market, significant risk transfer market, which those transactions may be both STS and non-STS, and it's typically in the fourth quarter of each calendar year most activity is there, where banks are typically targeting year end to transfer risk from their bank's balance sheet and free up regulatory capital. So that is a calendar effect. And to answer another question which I saw on there, is that these volumes are portfolio notional. I saw one of the Q&A was on that point. Exactly. This is not tranche level. It's portfolio notional level.
Yeah. No, exactly. I have on my hand one question, because there were some of the participants may be aware that there was a FSB report on securitisation few months ago now, where they evaluate the effect of the reform of securitisation. But one point they mention is that 70% of RMBS and ABS are written by banks, and you mentioned that in your chart on the. So one question that we may have is why banks are returning. So you mentioned that it's for liquidity purposes and collateral to central banks, but can we say that this return could be unlocked if the prudential rules were and all the package of measures that we propose were adopted in a way, or there will be I guess always a part which will be retained because for liquidity purposes also to the central banks?
Yeah, I mean, I think there's a couple of effects going on. One is clearly the unwinding of central bank support schemes post crises, and that there was that was a support mechanism that enabled through the likes of TLTRO banks to access liquidity from the central banks. As those unwind, banks will be increasingly asked to obtain funding from the market. That's one effect. The second effect is, and we see this when we speak to AFME's members frequently. When you look at some of the transactions that they look to place, and we're talking about senior AAA, AA notes, there just is not the capacity to place. There's not the investor demand. So they have to retain often an element of that senior tranche because there isn't the. And so what these reforms, to answer your question, we hope will do is create that demand, and it's not going to happen overnight. Solvency II will require Solvency II reforms will require obviously insurers to retool, but it is the first step to allow to support that retooling and allowing insurers to diversify their investor their product.
Yeah. No, thanks, Sean. I see another question about the P factor, whether it was a BCBS requirement or EU EU only. It's a Basel requirement. I think we are arriving at the end of this webinar. And so I would like to thank very much Sean and Thomas for their time and all the expertise and insight throughout this almost 1 hour and 15 minutes. I hope that all the audience will have found this webinar helpful, and please engage with us if you would like to share and have different, even if you have different views or just have follow-up questions. As we said at the very beginning of this webinar, we will share the two presentations and our contact details, so that will be again an opportunity for you to reflect on those input and to reach out to us if you have any questions on Thomas' presentation. Of course, you can reach out to him directly on AFME work, including all the research pieces that Sean has put at the end of his presentation. So we can't have a round of applause for Thomas and Sean, but please thank them. I'm really happy to have them with us, and thank you to Thomas and Sean, and thank you to all of the participants for having joined this webinar. Thank you very much, and have a nice Friday.
Thank you, Remy. Thanks for your moderation.
Thanks, Remy. Thanks, everyone.
Thank you. Bye-bye.